In this week's update, a rather nothing sort of week globally. How to assess where to focus your attention, and headwinds turning for gold. My name's Gary Davis. As always, this is general advice only. And this is the kind of market where it's not a very difficult thing to lose money, probably more so than at any time that I've ever seen. So you're going to see an emphasis on risk management in the future. It's easy to be dazzled by the opportunities. It's easy to get really engrossed in the chase of an investment, but risk management really is one of the most important things that you should be thinking about. And please remember to like and subscribe to these videos. All right, the market perspective is now really factoring in and accommodating the possibility that we've seen the peak in the rise of interest rates, or at least the momentum. That's not to say that we've seen the absolute highs in the interest rates. I don't think too many people believe that. But that we're not that far away from a peak, and that the rate of rise is going to slow down to a degree. And as the probabilities are seen to rise, and the market always starts pricing these things in advance, then we are going to see pricing move up, and that's started to happen already. Now, whether that gets sustained or not remains to be seen, but that's where we sit at the moment. But there are many offsetting risks, just a couple of them. COVID in China has just hit a record in the last week. I think 36,000 cases per day. So that has obvious implications, and the lockdowns that go with that for a global economy, and particularly for the Australian economy. What Putin does is an absolute wild card and could have significant ramifications. Geopolitics on oil is impossible to read. And they're just a few. You could come up with a very, very long list. So whilst the market is starting to price in the possibility that the rate of rate increase will slow, there are plenty of things that could also be market disruptive as well. So hence risk management is so important. Now, it's likely that a sector strength approach will continue to work very well. Buying the dips in the strongest sectors, strongest stocks, strongest industry groups has always been a pretty good strategy. Now, at some point, any sector or group gets overheated and there is a decent reversal, and that reversal can be 20, 30, 40%. But as long as you've got a game plan to deal with that reversal, then following the strongest sectors has proven to be a very, very good long-term strategy. Turning to American stocks, and I'll have more to say on that in just a minute. The S&P added 1.5% on a shortened week. All 11 sectors rose. Energy was surprisingly the lowest. Energy has been the strongest weekly sector for so long. Energy went up very slightly. I think it was like 0.2%, but it was at the bottom of the pecking order. Utilities and materials were at the top of the pecking order. So that's a bit of an eclectic mix, really. When you look through the top 4 or 5, they were neither aggressive or defensive sectors. It was a real mix. Beg your pardon. Excuse my cough. Just got a bit of a throat this morning. The US dollar index continued its downtrend down to just a tick under 106, and that certainly helped commodities a little bit. The 10-year yield was lower. That certainly helped some of the aggressive sectors, down to 3.7. The VIX is almost down under 20, and it was only a few weeks ago that it was up around 30, so that's been quite a dramatic shift in conjunction with the 10-year yield coming off. But the 10-year, 2-year spread continues to widen. We're now up to 0.74. So the market's, pretty much pricing in a recession as a given. And recessions affect different stocks differently, and hence the importance of risk management and the need for a very clear game plan in what you're doing. So let's jump in and take a look at some of the US sectors and then some of the Australian sectors to get a sense of where your focus should be. So the things that I'd like you to look at a big picture level is firstly the angle and direction of the 200-day moving average, the red line. Is it pointing up or is it pointing down, and what is the steepness of that angle? Second thing is, where is the price in relation to the 200-day moving average? Is it above it or below it? Thirdly, are the shorter term moving averages, the 20-day and the 50-day, are they confirming a change in direction? In other words, if a sector's been out of favour for a significant period of time, is there enough evidence there to indicate that it's turned? Because if you wait for the 200-day moving average to turn up, you've missed a heck of a lot of the action. So, you can't really wait for that to happen unless you're a very long-term investor. So then that establishes effectively where the money is going this week, next month, perhaps for the next 3 months. And then the next step for me is finding the strongest players in that industry group or in that sector. And it's not a perfect formula. It doesn't deliver you a positive outcome every time, but it has a very good reliability and a high probability of success. And that's all we have in the market, it's probabilities. And we can see here from the XLE, it's been the strongest trend in town. And any pullbacks to the 200-day moving average has been a fabulous buying opportunity. And that has been the case, as far back as we can see on this chart, which is nearly 15, 16 months. So that's the XLE. But we're at an elevated level at the moment, so probably not a great time to be building exposure to energy. So you need to wait for a dip. This is finance. 200-day moving average down, but the price above, and the 200 and the shorter term moving average is turning up. We're just about to break out. So a possibility. Now that's at the overall sector level. The best performers in finance are actually doing far, far better, and their trends look great. So, there's certainly plenty of opportunity in that area. This is technology. You can see pretty clearly, still lagging. Little bit of a glimmer of hope. There might be a few gems in here, but by and large, this is a sector that's still lagging. XLC, communications, services, another aggressive sector. There's really nothing there at all that would get your motor running at this stage. This is XLV, healthcare. It's had a short-term nice move, bit of a breakout. It's above the 200-day moving average. So this one is sort of neutral, perhaps providing some opportunities. And again, at an individual stock level, there have been some extremely strong performers in the last couple of weeks. XLY is difficult because it's so heavily dependent on what Amazon and Tesla do, making up around 35-40% of the index. So this is a bit of a hard one to make decisions around, but at this point in time, it's still looking fairly negative. And finally, this is XLP, consumer staples. We're back above the 200-day moving average, but it's like healthcare, it's relatively neutral. Now, if we go to the Australian market, this is small caps, not doing too badly, but still in a technical downtrend at a big picture level. Materials, above the 200-day, so at the index level, you'd call this neutral. But at, let's say, the lithium majors level, it's been outrageously positive. So again, you've got to drill down a bit to find some of the targets. The ASX 200 overall looks this way. It's broken out above a prior peak. The 200-day moving average is just starting to flatten out, and if this trend continues, then obviously the 200-day will turn up. So that's fairly positive for the Australian market. This is healthcare, pretty similar to healthcare in the States. And finally, this is second to last, this is finance. So looks somewhat similar to finance in the US. And our energy sector is looking very similar to the US. But I must say that our energy sector is, I find, difficult to trade and invest in because, sure, Woodside's doing well and maybe Santos is doing okay. But when you get down to a lot of the mid-cap and smaller cap stocks, there are actually quite a few of them that are doing really badly. Difficult market, the Australian one. So let's look at now, having looked at the sectors, quick peek at the S&P, and it's better than, certainly better than the NASDAQ, but still hasn't managed to scramble its way back above that 200-day moving average. So the jury is still out on that one, but I think, as most people know, I don't place too much emphasis on what the indices are doing because we've got such a bifurcated market where some parts are doing incredibly well and other parts are still doing fairly poorly. So that's the NASDAQ. And if we look at small caps, then small caps, they're back above the 200-day moving average, only just. But again, that's a very, very broad church. Importantly, let's look at the spreads, the sectors. Where's the money going? Start, first of all, with the important one from my perspective, that's semiconductors versus the S&P. We've seen a significant improvement since the 18th of October. Didn't really do much last week, but at least it's holding those significant gains. So this is the relativity of consumer discretionary to the S&P. Discretionary versus staples, I'm placing less emphasis on at the moment. I just wish there was an index that excluded Tesla and Amazon so that I could get a clearer picture of how consumer discretionary stocks are really performing, but I'm not aware of one. Russell 1000 growth versus value, nothing too much happening there, no real improvement. Mid caps, pretty similar. And on a weekly basis, large cap growth versus large cap value, no real significant improvement. So this remains a market that I think is more stock specific than I can ever remember. So that's probably the overall message from this week. Just a quick look at currencies. The US dollar down. Certainly it turned down fairly sharply on the 4th of November. And the Aussie dollar, pretty much the mirror, and we finished at 66.76. So I think that's probably all that I wanted to say there. So if we look at the Australian stocks, our dollar 76.76. Our market also gained 1.5%. Hard to know how it'll go on Monday. To be honest, there was the Friday session in the US after the Thanksgiving holiday was pretty much a non-event. I don't think it's going to influence markets much. The sector indices in Australia are just so dependent on a few mega cap stocks that I don't take a great deal of information from them. I really prefer to work on an individual stock basis. Moving now to precious metals, gold was up a little bit, edged ahead to 1756, and at a slightly wider view, the collapse of cryptocurrencies, the lower US dollar, is certainly feeding into that. And then we've got this really interesting balance between what retail investors are doing and what central banks are doing. Now, the World Gold Council has reported in the last quarter that central bank buying reached $20 billion, which I'm not sure if it's an absolute record, but it's certainly far, far higher than we've seen for a very long period of time. So there's been a big increase there. And also central bank buying as a percentage of total demand has moved up quite significantly. I think it's moved up from around the 20s to, if I recall correctly, 37%. But gold ETFs, so money continues to flow out of gold ETFs, and they're actually down 47% year on year. So that's the third quarter of this year compared to the third quarter of 2021. That's according to the World Gold Council. So one side moving up, one side moving down. So the demand side is not really changing that much, but certainly some money moving back into the area. Cryptos was always a bit of a debate whether cryptocurrencies were stealing some of the investment dollars, and there's a bit of evidence now that perhaps that was the case, the investment dollars that would have gone into gold. Now the Australian dollar slipped again with the gold price not really doing much, but our currency rising. So we fell to 26.32. And the Aussie stocks have done really well in the last few weeks, a bit of a continuation of what we've seen. So let's take a look at the gold price. Okay, so this is on a weekly basis. We broke support. We stayed under there for about 6 weeks, and then we've rallied back, but cooled off in the last two. So still a little bit indeterminate. There's plenty of people now forecasting higher gold price. I don't pay much attention to that because they've got their own point of view. They might be just guessing. They might be trying to make a name for themselves. I wouldn't base your investing decisions on things that you read. Just, watch the money flows. And even more preferably, as I've been saying for a very long period of time, invest in stocks that can go up because their projects get de-risked, not because the gold price has to rise. I just think that's just a smarter way to do it. And that's the daily price for gold. And just a quick look at silver. Silver forming higher highs and higher lows. So a bit of encouragement there for anyone interested in silver. GDXJ is just threatening to break out. Not much, but it's looking certainly more positive than it was. And we've now clearly got higher highs and higher lows. So things looking a bit better there in the gold space. Other commodities, copper was down a few cents, but nickel actually went up about 30 cents. Crude oil came off to around 76.55. And let's just look at, sorry, wrong screen. There we've got it. I'm still coming to terms with using the mouse left-handed, so I'm a little bit slower around the keyboard than would normally be the case. All right, let's look at the 10-year Treasury yield over the last 6 months. I meant to look at this before. So you can see we got up close to 4.2. We've come off now to 3.7. It's not definitive, but at least the market is entertaining the possibility that that this could be a shift in interest rates. So this is the 10-year yield. So you might ask, well, why isn't it the same as what the Fed is doing? Well, the Fed is working on the cash rate, so that's the short-term rate, whereas this is the market at a 10-year view, putting its flavour on where they think the central bank is going to go. And crude oil, again, let's look at a 6-month view on crude oil. So we've come off consistently over the last 6 months. We peaked out at 120 back in June, and we're maybe just stabilising a little bit now, but we're certainly at the lower end of the range. So interesting to see where crude oil goes. Okay, there's the spot copper chart, nickel, and finally wrapping it up. I just sense a bullish tone into year end. There's certainly more positive commentary and a bit less negative commentary at the moment, but mainly from the charts. I just, when I look through several hundred charts, you just get a sense of where the money's going, and I'm seeing, a few breakdowns and few really ugly trends, and I'm seeing a fair amount of stabilisation, and I'm seeing some good uptrends. So, I just sense a bullish tone into year end, and there's no surprise there. I mean, after such a rough year, you would expect November and December to be better. It's almost the way that it happens. But look, Australia remains very much a stock picker's market. It really does. I have little confidence in the majority of the Australian market, but I have enormous confidence in some narrow parts of the Australian market. So the need for a clearly thought out plan that's right for you has never been greater. And I hope this message doesn't ever get boring, but I just know from interaction with many investors that a lot of people still don't ever, get down to tin tacks and do this and work out a clearly thought out plan for them. You can anticipate how you're going to respond to most things in the market. A lot of people sort of have the attitude that we're victims, that we just have to cop whatever the market throws at us. And that couldn't be further from the truth. There are a few things we can't control. We can't control sudden movements due to news or unexpected events, but we can control most things. So, set about learning how to do that if you don't know how to do it. Portfolio Analyst last week was about strategy. It was about some early stage mining stocks and using what I would call a basket approach. There's a huge amount of risk in small cap copper, lithium, nickel, early stage stocks that mightn't commercialise for 2, 3, 4 years. A great deal of risk, always has been, always will be. But if you take a bit of a different approach to that, using holding a basket of individually a lot of very small positions, it can be very productive, because it only takes 1 or 2 stocks in a basket to do well, and the basket will do well. So a bit of focus on that. Now, upcoming, consistent with what I said at the start, is a major focus on risk management for different types of investors. One message and one method of operating in the market is never going to cut it. You could paint a scenario of 3 different investors where their decisions to the same information are quite different. So you've got to really identify what type of investor that you are. So I'm going to be putting quite a focus on that in coming weeks in Portfolio Analyst, and indeed within the Insiders Club as well. All right, that's it for this week. More information on the website. My email address is there for anyone that would like it. And we'll be back with you next Sunday. Cheers.